Hey, welcome to the 40 Finance channel, everybody. Today we're going to talk about the QQQ and the idea that perhaps the QQQ is in a big bubble right now. This comes up from an article I recently read on Seeking Alpha, where it says QQQ shows at least 4 bubble signs amid post-election rallies. If you're new to the channel, I'm a big fan of the QQQ and I follow it very closely. So I thought for fun today, I'd go through the points here in this article and just share my take. Quick promotion as we go through the video. You're going to see a lot of stuff from Seeking Alpha on here. It's a platform I use all the time. My affiliate link is in the description. Gets you a huge discount on the sale that they're having right now. So definitely check it out if you see some stuff that you like on the screen. Okay, let's jump in. This article was published on November 19th. Today is, what's today? Today is the 22nd of November. It's from an analyst on the platform called Sensor Unlimited. So we've got 4 things here. We got high valuation, broad bullish sentiment, unsustainable growth projections, and larger than expected tightening risks. Right off the bat of these 4, the larger than expected tightening risks, I'm not going to refute that per se, but I don't think that that's something that can be measured. I think that that's just generally an opinion. To the author's credit, he gives his ideas of how that's going to work based on the Treasury rate. I'm not going to get into that because I'm not an economist, but I will say fair. Out of your 4 points, that one is fair. I don't think anyone really knows what's going on in the tightening landscape, so to speak, until we get the change of office. But let's take a look at some of these other ones. We have high valuation ratios. So what I did here is I've got the top 10 holdings of the QQQ, and you see them, and that makes up 50% of the entire portfolio. Of course, one of the things that people often miss with an ETF like this is that it does rebalance quarterly. And you have additions and subtractions, and we are going to be coming up to that time when the holdings for the Qs in 2025 are going to be different than they were in 2024. But all we have is today, so let's take a look at today. And we're going to start with NVIDIA. So I'm going to go into NVIDIA's stock page. We're going to look at the valuation. We're going to do this for all of the top stocks. And let's just see where things stand. You've got PE non-GAAP trailing 12 months at 56 right now. NVIDIA's 5-year average is 63. You have non-GAAP forward at 50. Their 5-year average is 47.65. If you want to go on the gap metrics, 57 versus the average of 85, and gap forward 50 versus 63. So at least valuation-wise on NVIDIA, both the current or last 12 months and forward, if you were to compare that to the 5-year average, which I often do, I'm not necessarily seeing anything here with NVIDIA on being wildly overvalued, at least not from a PE ratio. All right, next on the list is Apple, same exercise, non-GAAP trailing 12 months, 33, 5-year average, 29, so higher than that. Forward, about 31, 5-year average of 28. Then if you go on the gap side, it's 37.50 versus 29.25, and then 31 again versus 27.86. You see this other column, which is percentage difference to the 5-year average. It is running double digits higher from a percentage standpoint. So Apple, as far as potentially being overvalued, P/E ratio-wise, I could see that. It's not by a ton, but it is definitely there. There's evidence to support that argument with Apple. All right, Amazon. And Amazon is, of course, interesting because they're kind of, turning things around in the profitability part of the business. So their numbers are a little harder to read when you think about it from a current day versus 5-year average, but we'll do it anyway. Non-GAAP, trailing 12 months, 42.48. 5-year average is 76. That's minus 44%. Non-GAAP forwards at 38. 5-year average 178. So they're well below their 5-year average. Now, PE on the GAAP side, there's not as much information on the 5-year average because Amazon's had some fluctuations with COVID and stuff on like pure profitability, not to mention, like I said, turning the ship around a little bit. But, just eyeballing it here, I would say that, Amazon, I wouldn't call it the highest valuation, certainly not over the past 5 years. All right, we'll pick off Meta, 2652 on the non-GAAP trailing 12 months. That is 4% higher than the 5-year average. If we look ahead, 24.9, that is 7% higher, up from 23. Now, on the GAAP side, 2659 versus 2613, so basically in line over the last 12 months. And then forward, just under 25. It's been, averaging about 23.35. So it is over or a little bit hotter, but you're talking 6% here. If you go back to that article and you think about some of the terminology that's used when you're talking about, wildly overvalued things, I don't see wildly overvalued here with Meta. All right, Broadcom. And Broadcom, to be fair, I feel like is running a little hot, and it shows. So here, PE non-GAAP at 36. 5-year average is 21. 33, call it 34, looking ahead. 5-year average is 19. So here you got plus 70% on the non-GAAP PE. And then on the GAAP PE, we'll just skip to the punchline. You're triple digits over. Broadcom, this is off the top of my head, but it's another one with chips where the profitability scale is up and down. It's up and down. It's one of those markets. Chips are very hard. It's almost amazing the run that chip stocks have had here in the past recent history. I'm not surprised that Broadcom is showing signs of being overvalued. So we'll have to say that one is true, at least from these numbers. All right, Tesla, looking at non-GAAP at 141. 5-year average is 137. That's plus 3%. The forward of 137 is 20% over the 5-year average. And then if you get into GAAP, Tesla doesn't have a ton of history to do GAAP. But if we at least go GAAP forward at 162, 5-year average of 300, it's well under that. What's interesting about Tesla, beyond these numbers is the limited history of the company in general and the fact of where they've been to where they are now in terms of profitability and whatnot. They might be slightly overvalued compared to themselves. Next is Costco, definitely running hot. 59 on the non-GAAP trailing 12 months versus 41. And then looking forward, you got 53 versus 39. That's plus 35%. And on the GAAP lines, right about the same. Plus 37 on the current GAAP PE, plus 36 on the forward. So Costco is definitely showing, I could see the argument that Costco is overvalued right now. All right, last on the board, I just picked one of the Googles here. You got 22 PE non-GAAP trailing 12 months versus 26, and non-GAAP forward of 21 is 17% under the 5-year average. And then if we get into GAAP metrics, you can see the bottom line here. You're talking about minus 18% or so across the board. Google definitely not overvalued in my opinion when you at least look at these metrics. All right, so that was high valuation ratios. Off the top of my head, what do we have there? Like maybe 3. Broadcom, maybe Tesla, Costco definitely. 3 out of those stocks that we covered, I could say, all right, I'd sit down and listen to somebody if they said overvalued on them from a PE ratio standpoint. The other thing that we can track in this top 50 is unsustainable growth projections. Okay, so let's go back. We'll do it very quickly here with NVIDIA. We're going to go to the growth tab on Seeking Alpha. All right, revenue growth year over year. Huge, huge. 152%. I mean, you just don't see that in a huge company. Well over the 5-year average of plus 50%. Looking ahead, folks are still calling for plus 92 as far as the consensus, way above the 5-year average. So you got two things here, okay? The past was outstanding, and it certainly outperformed the 5-year average. What's interesting is the forward, unsustainable growth projections. The forward would fall into that in the sense that 92% is smaller than 152%. But when you think about it in terms of the stock and performance, you're still plus triple digits over the 5-year average. So what that could mean is NVIDIA may not go up as quickly, price rise, valuation-wise, however you want to look at it, but they're still growing. Okay, a company that is still producing these numbers is going to have a lot of momentum. So is this an unsustainable pattern? Very tough to say with AI, but I would say looking ahead over the next 12 months, they're doing a good job, NVIDIA is, of continuing the momentum. Okay, Apple, how unsustainable would their growth be? Well, first of all, year over year, they're at 2%. All right, so they're not hardly growing revenue-wise to start with. Next year, that is projected to basically double, but 5-year average, they are behind the 8 ball on 5-year average in terms of their revenue growth. Apple, once again, this is a stock that a lot of people study, and if you stare at it and stare at it and stare at it, you say to yourself, single-digit growth for a long time now, what other tricks do they have up their sleeve? Yet somehow, through share buybacks and things like that, the stock price accelerates. They know how to play the stock game. I certainly wouldn't call single-digit growth unsustainable at any point in the journey, so I wouldn't worry about that. The trick is, can they get even back to clearing plus 5% on the growth? That's what we're going to have to see. All right, Amazon. And with Amazon, unsustainable growth rate, well, it was only 12% last year, and it actually is projected to go down a hair, closer to 11% next year. Both of those are below the 5-year average, and we know the game with Amazon. Obviously, it's getting bigger. The cloud atmosphere, is doing great, but that's a big part of their growth. I don't know necessarily if I see a warning sign here when you're already running growth down from your 5-year average and you're staying steady in the 11%. I think with Amazon, what you got to start seeing out of them stock-wise is just a little more lean towards the earnings per share, and I think they're figuring that out, because at least from an enterprise level with AI, considering their cloud customers, there's certainly a lot to be done there, and that's where the big money is. That, I would say, is a growth lever that is certainly possible, but I don't know if they've executed on any great ideas yet. All right, Meta growth, unsustainable. Let's see, year over year, it's 23%, 5-year average, 19%. That's up over 16%. And then revenue growth forward of 17% projected is basically right in line. So is that unprecedented growth? I don't think so. I would say the Meta machine just keeps churning along. How about Broadcom unsustainable growth metrics? Well, year over year, they hit 32%, plus 32, way above their 5-year average of 13.5. And revenue growth for next year still in the 20s, which is 85% above their 5-year average. So it doesn't look like, at least the early projections, anticipate much problem for Broadcom maintaining this kind of growth. Tesla, 1% growth last year, or year over year, I should say, way down from their 5-year average of 35%. Looking ahead, they get back to double digits, which would obviously be a boon to their stock. It's below their 5-year average of 33%. Of course, they had the mega growth years if you go all the way back to 2019. So that's 62% off their average. I don't know if they'll ever get back to that 30 some odd percent here in the short term, but unsustainable growth at 12%, I don't think is a fair statement. Costco, looking at their revenue growth, 5% and 6% forward, those are actually way off the 5-year averages. I'm sure that the COVID boom for Costco, we know what that did for the company, so that's going to drive those up. But if anything else, if you're going to argue unsustainable revenue growth for a company like Costco at 5%, well, the early projections have them beating that next year, so I don't see it as a concern. All right, next up we have Google, year over year, 14%, 5-year average, 17.8. So they're actually under their 5-year average. And looking ahead, over double digits at 11.35. That is under their 5-year average by 28%. So the outlook for Google that's in the market right now of 11% revenue growth is not really like super exciting. So to come back and put them in a bucket where you would say unsustainable growth, I just don't think that's true. All right, checking back in on our article here, unsustainable growth projections, I don't see that. I don't see that as a case for the bubble for the QQQ. We already talked about high valuation. I don't see that. Larger than expected tightening risks, I'm going to bow out of the argument. And then lastly, broad bullish sentiment. I would say, given what we've seen in COVID with broad bullish sentiment and how that compares today, I don't see that necessarily being on the same scale. And I would also say if you're going to be bullish about something, these mega cap plays are probably the safest of all of them. So if you go back to COVID times and you're talking about a lot of small caps and just crazy stories sprouting up from nowhere, with the Qs and the sheer number of volume and as tight or as intertwined as it is with the market, not to say that it can't go down, but I would feel that it's much harder to build a bubble out of the Qs because it takes so much to move the names. All right, guys, so that's my response of QQQ being in a bubble, at least in relation to the 4 reasons that were given here. Let me know what you think. And don't forget, if you liked some of the screens that you saw here with Seeking Alpha, my affiliate link is in the description. Gets you a substantial Black Friday discount right now. So definitely check that out. It's a great deal. Hope everybody is doing well. We'll see you on the next video.